A long strangle costs 30% less than a straddle, but often requires a 50% larger move to break even. Here is how to choose based on volatility, not just price. When you expect a massive stock move but don't know the direction, you have two primary choices: the straddle or the strangle. The straddle buys the at-the-money call and put, giving you maximum exposure immediately. The strangle buys out-of-the-money options, lowering your upfront cost, but widening the gap to profitability. Let's look at the structural difference directly. The straddle is pure aggression. You strike right at the current price. The strangle is defensive regarding cost. You widen your strikes to lower the premium paid. Many traders default to the strangle simply because it is cheaper. If a straddle costs $500, a strangle might only cost $300. However, options pricing follows the rule of no free lunch. The lower cost of the strangle creates a dead zone. Because your strikes are further apart, the stock must move significantly just to reach the strike price, let alone your break-even point. Here is the math that catches most beginners off guard. To calculate the break-even on a strangle, you must add the premium paid to the call strike and subtract it from the put strike. This widens your goalposts significantly compared to the straddle. This brings us to the concept of implied volatility, or IV. Both strategies are long vega, meaning they profit when uncertainty increases. However, they react differently to the expected move priced into the market. If the market expects a $5 move, the straddle will usually price in that exact $5 move. If you buy the straddle, you are betting the market is wrong and the move will be $6 or $7. You are fighting market efficiency head-on. The strangle, however, is a leverage play on gamma. Because the options are cheap, if the stock makes a massive, unexpected 3 standard deviation move, the strangle's return on investment, ROI, will crush the straddle's ROI. Let's compare the Greeks. The straddle has higher delta and gamma initially, meaning it reacts instantly to price changes. The strangle starts with low sensitivity but accelerates rapidly if the price approaches your strikes. This leads to a critical rule: timing. Straddles are for now, when you expect the move to start immediately. Strangles are better suited for binary events where the move might be violent enough to skip over the dead zone. But beware the IV crush. If you buy either strategy right before an earnings announcement, the premium is already inflated. When the news drops, IV collapses. The stock might move, but your option value could still drop. To avoid this, compare implied volatility to historical volatility. You only want to be a buyer of straddles or strangles when implied volatility is relatively low compared to the stock's past behavior. We can quantify this using IV rank. If IV rank is above 50, premiums are expensive. Statistically, you should be selling, not buying. If IV rank is below 30, straddles and strangles become viable. Here is the ultimate decision framework. Use a straddle when you believe the move is imminent and you want to minimize the miss risk. You are willing to pay more to ensure you participate in even a moderate move. Use a strangle when you are betting on a black swan or outlier event. You want to keep capital risk low, accepting that you will lose 100% of your small premium most of the time, chasing that one 500% winner. Let's visualize the break-even comparison one last time. Notice how the strangle requires the stock price to travel much further before you see a single dollar of profit. A pro tip for managing these trades: do not hold them until expiration. The rate of time decay, or theta, accelerates in the final days. Manage your winners at 25% to 50% profit. If the trade goes against you and the stock stays flat, cut your losses early. The worst thing you can do with a long volatility strategy is hope for a move that isn't coming while time decay eats your capital. So which wins? The straddle wins on probability of profit because the break-even is closer. The strangle wins on return on capital if a massive move occurs. In summary, if you are trading earnings or high volatility, be careful buying either. But if the market is asleep and you sense a wake-up call, choose the straddle for reliability and the strangle for leverage. Calculate the expected move before you buy the premium.